All right. Hi, everyone. This is Karen Spence. I'm Karen Spence, and this is our second Virtus Wealth Management webinar. And I have Chuck Elhoff here with me. He is a partner in our firm. And I also have Brian Tillotson. He is on the webinar. You can't see him, but he's there. And we are all going to be available to answer questions as we go along. We are wanting you guys to ask questions as we go through the webinar. So this webinar, we are going to focus on recessions and risks, and we are going to, Chuck is actually going to be giving us some of his experience because he has been in the business for over 40 years. And I am comparing Chuck to the farmer's insurance guy, our farmer's insurance commercials, where we know a thing or two because we've seen a thing or two.
There you go.
So we are going to get some wisdom from Chuck and kind of compare past recessions to what's happening today and just see if we can kind of take any comfort in that. And then the next topic, we're going to talk about risk tolerance and what taking risk means and how that can affect you. And then I'm even going to take it a step further. You know, a lot of times when you're going through something like this, you'll hear on TV or advisors say, well, you just need to hold tight, you know, don't do anything, stick with your strategy, which is true and maybe not true depending on what your strategy is. So that can be very stressful. And so we want to address that with you guys today as well. So before we get started, I'm going to do some administrative webinar discussions. You'll see that we do not have the chat enabled. That is, we are not allowed to do that per compliance. So there's no chat feature, but again, we are encouraging questions. So if you do have a question as we go along, we're gonna, if you can email those to Amy, she has access to her email and they will get the questions to us. That way, you know, we can take them at the end. And one of the things that we're doing to encourage questions, we're not just saying it, we are encouraging it by offering a $50 gift card to the restaurant of your choice. We're going to do a drawing, so not everyone will get one, but we're going to do a drawing from the questions. And then in 2 weeks, when we have our next webinar, we will announce who the winner of that gift card is. So, and we're going to be actually announcing a winner for our prior webinar today at the end. So again, if you want to ask questions, then you can email those to Amy. And then the last thing before we get started was some more disclosures because we are heavily regulated. So anything that we talk about today is for informational purposes only. We can't give you specific advice because we're not talking to you directly. So keep that in mind. Past performance doesn't guarantee future performance, and not all strategies are going to work to prevent all losses. You know, some work better and sometimes, and others are better and other times. So just keep that in mind as we're going through this discussion. So with that, I'm going to kind of turn it over to Chuck so we can talk with him again about past recessions and just kind of start with that.
So that was kind of like reading everybody their rights before we started.
Yes.
Okay, good. Yes, so in looking back as far as 1970, we've had 5 recessions or bear markets. And we'd call a recession or bear market where the markets fall 20% or more and we have significant unemployment. Now, I'm not going to review all of those, but I will mention the 1980s. So how many remember the 1980s?
Not me.
So I will share with you that during that time frame, we had interest rates, money market interest rates, as high as 16 to 18%. Sounds
Crazy.
pretty good today, right?
Yeah, it sounds
How
good.
would you like mortgage rates and people taking out mortgages at 13, 14%?
That sounds really bad and impossible.
Yeah, and then we also had double-digit inflation. So, you know, just like now, everyone's sitting around wondering, is this going to go on forever? What's this all about? So anyway, that was a difficult time. And I remember meeting with one of my older clients, and he was trying to make a decision on an investment. It's either an investment or insurance product. And so I shared with him, I said, you know, Bill, if you ever think we're going to see 8% interest rates again, you should not do this. And he scoffed at me, and you know, I was respectful because he's older than I was. But I said, you know, really? He says, you're crazy. We'll never see 8% interest rates again. I said, okay.
Meaning it'll never get that low again.
It'll never go down that low. So, well, here we are today. What if I ask that same question? It's a different.
Right, a whole different spin, right?
Will it ever go up to 8%?
And I would say no, it'd never go up. But I'd love it if it did, right? So
So here we are, pretty much a 0% interest rate environment, and so things change. So in that time frame of 1980s, we had this 1986 Tax Reform Act, because we also had high income taxes at that time, and so the Tax Reform Act reduced income taxes, but it made significant changes in tax deductions, and specifically to real estate, and you can see real estate almost overnight drop in value as much as 50%. And that led to the savings and loan crisis, because at that time, for most real estate, savings and loans were providing the finance. So now all of a sudden, they've got no collateral, and so now we really do have a significant recession, and we're gone. You know, it's just a bad time. But this will be a common theme as we go through here. The markets did recover. So the 1990s were really very good. The economy was strong, markets were good.
It's like every decade we have something like this.
Well, we're going to have them.
Okay, I'm ready. Keep going, Chuck.
So all of a sudden, about in the mid-90s, late 90s, people started realizing that, okay, we're all reliant on computers now, and our computers click over two numbers. So we went from 89 to 90, and the computers were fine. We go to 92 to 93, computers were fine. But we got to thinking, whoa, what's going to happen when we go from 99 to 00? Will everything shut down? Will we lose everything? Is the world going to collapse?
Now this I can relate to, because in 2000, I was in the IT industry, and I was a programmer then, and so I was on projects to get all the systems updated for Y2K.
So what happened is a lot of software companies started developing different software products. There were a lot of dotcom technical companies coming out. People were buying these companies, and they were getting returns of 10, 20%. So has anybody out there bought any of those and had a wonderful time making that kind of money? So what happens is we attend a conference, because at that particular time, as we are now, we were kind of in the mode of advisors saying you need modern portfolio theory, you need to diversify, you need to have large companies, small companies, domestic, international, growth, value. And so we were very diversified. So I had clients, calling and say, hey, what's the deal here? My friends are making 10, 20%. I'm so diversified, I'm not making much money. It's like, really? And I'm going, well, it's risky, modern portfolio theory, you need to be diversified. So we hung pretty tough with our clients, but it was a difficult time. And I attended a conference, and most of us were in that same mode of modern portfolio theory. And so we were asking, hey, are we doing something wrong here? They're buying these companies, they're making money. And so the answer was, well, what these companies are doing, they're selling dollar bills for 95 cents. And one of these days, they're going to have to figure out how to make up that nickel, and plus people are going to want something for their 95 cents. Well, we all know what happened. Y2K comes, computers clicked over, 00. Nothing happens.
Everything's fine.
Everything's fine. So now what happens? We have the dot-com crash. So all these companies, just a lot of them went bust. People lost a lot of money. So now I'm sitting there looking at my clients, and my most aggressively invested clients were probably down 10. Everybody else was down 20% or more. And many of my clients actually made money and stayed even during that time. So now I'm thinking, wow, I'm a pretty smart puppy. I got this figured out. This
diversification, that worked for us.
Because, quite frankly, during that time when clients were questioning me, I was saying, okay, am I the one that drank the Kool-Aid? If I bought into something that's not right, and now all of a sudden it's been confirmed that yes, diversification works. So even with all that, once again, markets recover. So now we move into the 2008, 2009 era. Have any memories of that?
I do have memories of that. In 2006, I started working at Virtus Wealth Management. So been here a couple of years by then. And I was working with Brian then, and I really did see, in that case, diversification didn't really help us out that much. Everything was down. It was kind of across the board. And so it was like, that one was a little bit even different.
Well, even to this day, it's known as a Great Recession, because you're absolutely right. There was nowhere to duck, run, or hide. Everything went down. It was a subprime mortgage crisis, and credit markets really didn't exist. The government had to bail out Bear Stearns. Lehman Brothers goes broke. And so once again, we're sitting there in a position of what in the world's going on? You have significant questions. How do we ever get past this? And the only people that really survived during that time were those that had significant cash values in their life insurance policies, or they had cash balances because, as you said, everything went down.
And just understand, guys, you know, cash value life insurance, that's another way to diversify. You know, it's kind of beyond investments, but it's kind of similar to investments. So it just doesn't, it's not correlated, I guess I should say.
Yes. No, it's, I mean, that's one of the reasons you have it, because we know these are going to happen.
Yeah.
So those were the most difficult 2 years of my life, just being empathetic with my clients, helping them stay the course, be disciplined, because it was a difficult time. And so when this is all over, I don't want to go through that again. I don't want my clients to go through it again. So now my question is, okay, now what? So what I did, I said, you know, we might have to have some active managers in this process. But in the past, I rejected active management. And I rejected timing services because I did actually use a timing service for myself and a few clients previously. And the idea was, pay us a fee. We'll tell you when the markets are safe. We'll put it in the market for you. And when it's risky, we'll take it out. Perfect.
Hard to do.
That's what we're all looking for. Ideal.
Okay.
So we wake up, you know, a year or two later, and basically all we've done is paid fees, and what they said they could do, they couldn't do. And it's pretty much a consensus that one can't time the markets. And on the other hand, active management was one of those that was continually looked at. And for the most part, I would say the majority of active managers really didn't beat the market. So you're paying fees. Now with active management, you have to expect you're going to pay higher fees because they're actively managing. They're looking at stocks. They're trying to do different things. And so they have higher fees. And some of them could be 3, 4, 5, 6%. So before you and I as investors make any money, they got a pretty good nut to cut.
Right.
And so that's an issue. And then when a fund is really successful, all of a sudden, lots of cash flies into them. And now they got more money than they got places to invest. And
then it's hard for them.
Yeah. So a lot of instances, the one that was the best the year before is now the worst the next year. So, you know, I just really stayed away from it. Well, all of a sudden, I got a wake-up call. I'm committed that I'm not going to go through this again. I don't want my clients to go through this again. So I started calling in different managers to come to my office that I saw had done well, reasonably well in 2008.
And these are active managers.
Those were active managers.
Right.
So when they came in, I said, okay, I got 3 parameters because I'm trying to kick them out of my office.
Right. You wanted them to prove.
Yep.
Right. Okay.
So the parameters I laid out to them, I said, okay, first of all, you got to have a long-term track record. Don't tell me you started in 2008 and you did really good, because you might have got lucky.
Right.
So I need at least a 10-year track record. The second thing is, I says, okay, you got to be down in down markets.
Right.
Now, the reason I'm sensitive to that, because early on, I had the firm come into my office and they say, hey, Chuck, we got this great fund. And we're going to start putting money with them. It's Ryan Investment Tremont Advisors. Okay, what's the big deal? So they showed me their returns, and they were like double digits every year, 10, 20% every year. I'm going, whoa.
Wow, they know what they're doing. No.
Yeah, well, that's my question. So how are they doing this?
Right.
He says, well, I think they're buying the best 30 stocks on the Standard & Poor's 500, and then they're shorting the rest of the index. I go, no. I says, that's a college student idea. I need to know how they're doing this, because if I show it to clients, I'm telling you they're going to want to invest in it. I want to invest in it. So you need to get back to me on how this is happening before we go any further. Well, by the grace of God, before they got back to me, Bernie Madoff was uncovered and found to be running a Ponzi scheme. And it turns out that the number 2 fundraiser for Bernie Madoff was Ryan Investment Tremont Advisors. So I have sensitivity that I want managers to be down and down. I just don't want you down as much. I mean, let's not be stupid about this, but I do want them down. And then the last one was your fees cannot exceed 2%. Now, that's not just your fee. That's my firm's fees, your fees, trading costs, management fees cannot be more than 2%. Well, that usually eliminates most all of them. So I ended up with 3 that met those parameters. And so we're off and running and saying, okay, that's what we're going to do. And I'm proud to say that my partner, Brian, met those 3 parameters. And so we do use now diversification by asset classes, large, small, international, domestic, large, growth and value.
Mm-hmm.
But we also diversify by management styles. So we have the buy and hold manager, strategic, and then we have active managers as well.
We're using kind of a combination of everything.
Yep.
Mm-hmm.
That's
because we've learned a thing or two.
Yes, I did. Thank you. I
Yes,
did
we
learn
are.
a thing or two.
Learn a thing or two, seen a thing or two,
That
know
was-
a thing or two.
That was not a good time. So yes, so that kind of leads us into our conversation that we might want to have about this thing called risk.
All risk, right? So, you know, here we are in 2020. We have this pandemic going on, right? And we don't really know what's going to happen, right? I mean, it could, you know, there could be a vaccine or a treatment come out, and you know, we could recover quickly. There could be a second wave in the fall, you know, so we really don't know what's going to happen here. And there's risk there. So what do you think about that, Chuck? I mean, how do we?
Well, a couple things. When we have clients, and most, I'm sure all of you at one time or another had to fill out what's called a risk tolerance questionnaire.
Mm-hmm.
It's kind of a regulatory thing that we have to do.
Yeah, they're kind of
Now,
boring too.
I know.
I mean, but
I know the answers before you ever look at it, because it says, okay, if I'm down 10%, I can make this much money. If I'm down 20%, I can make even more. And if I can be down 30% one year, I can make. And the answer is, I don't want to ever be down. I want double-digit returns. I want it tax-free, and I want it guaranteed.
yeah, go Chuck.
Yeah. So why am I filling this thing? Well, it's a requirement, but it's an opportunity for us to learn a little bit about what you're thinking at the current stage. So. And there's a little, you come up short on that a lot of times, because I remember I had a little old lady wanted to invest money. She'd never invested before. I says, well, okay, so she had $50,000 she wanted to invest. So I put her in a conservative investment, but it did have some equities. I said, this could go down, but most of the time it's going to go up. It'll be fine.
Mm-hmm.
And after 1 year, when I came back to visit with her, her $50,000 was now $49,900. Yeah, it was uh-oh. Now, everybody else was down 20%. She was down $100. And I'm thinking, okay, she'll be happy. She wasn't happy. And so I had to ask her, I said, okay, so let me ask you something. If I give me $100 and I come back with 99 cents, you're not? No. Well, what if it's 50,000 and next year it's $50,001? It's fine. Really? Well, I never asked that question.
Okay. Mm-hmm.
So that's part of our process. And the other thing I would share is that when someone says risk, we've got to ask the question, what risk? Because all investments have risk.
Right. And everyone needs to understand that. You know?
So we have market risk. And as my partner Brian reminds us, that there's probably 3 to 5 different types of market risk. But for today's purposes, we're talking about loss of principal or principal value. Your 401k is down, your portfolio's down. So yes, I mean, you got to expect that there's going to be some time. You could have owned the most wonderful stock in the world, and if for some reason the markets are down, it's going to go down.
Mm-hmm.
It's just a fact of the matter that that's what's going to happen. The other one, you say, well, I don't want that, so I'm going to put it in a CD. I just want it at the bank, guaranteed, principal never changes. Okay, perfect. But as I said, in the 80s, we had double-digit inflation.
Right.
So if you have your money locked up in an interest rate and we have significant inflation, now you're losing purchasing power. So that's called purchasing power risk. And you need to be aware of it, and we're certainly cognizant of it and trying to make people aware that, okay, you can't go too far that way.
Mm-hmm.
Then we also have folks that invest in real estate or other types of investments that are paying them 6-7% when the best you can get on a treasury is, let's say, 2%.
Right.
Well, I'm getting more. Why? What's the risk? Well, it's liquidity risk. So if you needed that money, we can't get it for you. I mean, you say, hey, Jeff, Brian, Karen, I need that. Sorry. Or if we do go get it, it's going to be on the secondary market. You're going to take 40%, 60% cut in the price.
Right.
And then the last one, of course, is interest rate risk. So I may buy a bond that's paying me 2% in today's world. I'm thinking that's really good, but if interest rates go up to 4%, now all of a sudden my bond is worth half.
Right.
You call, say, I want that money. It's not worth what it was before.
Right.
So we always have to talk about, what risk are we talking about? And so what's a process? So what do you do? How do you overcome all of this? Well, I will share with you, it's interesting because when you have these risks and you know it's coming, I'll share with you again the Y2K experience.
Okay.
So in May of 1999, the discussion had already been had, okay, in 2000, something's going to happen, either nothing
Right.
and everything's fine, or it's going to drop 20%, but within 6 months, 9 months, it'll all come back.
Okay.
So I called my clients in. I said, okay, here's the deal. It's either going to be the same or it's going to drop 20. How are you going to feel when that happens? We're sitting here now. You can make a decision so you don't have to go through the being upset that the markets are down. What do you want to do?
And we
You want
see
to go
this
to cash?
coming.
What do you want to do? We see it coming. And then the other thing I shared with them, I says, okay, I was visiting with some clients with American Airlines, and they talked to Singapore, and they asked Singapore, what are you folks doing about Y2K? And the response was, well, is that a new airplane you got coming out? You go, whoa. So now there's concern, do the international markets have this under control? Are we going to have problems internationally? So clients look at me and go, I really don't want to answer this question. What do you think I got you for? But it says, okay, well, this is your money. I want to make sure you're comfortable. And so the decision I had one or two went to cash because they were concerned. Well, they're just being honest. It's good.
Right. Okay.
Many of them said, oh, international. Yeah, I don't think we're getting out of the international markets. So as it turns out, probably one of the best market returns in the international markets was the last 6 months of 1999. You would have known.
Right.
So what we do, as you well know, we all ask questions. And I always tell clients, I said, okay, I'm sorry, we're going to sound like cross-examining attorneys, but we will ask a lot of questions about how you feel about things. And so how do you manage these various risks? Well, there's financial answers. So yes, we can make determination of which different type of risk and what the magnitude of it is from a math and science standpoint.
Quantitative, right?
Yep. On the other hand, people have feelings about how they want to do it. I call it lifestyle. So there's lifestyle issues that have to come into play, which is kind of the art of what we do. Now, the science, the math, the finance part really doesn't change. What does change, though, is people's feelings. Because you get in a market environment like this is, okay, I know I told you 2 years ago that I'm fine with this. I'm not fine with this. This is not good. We got it. So that's something we continually visit with clients about and see if there's anything we can do on it. So as you mentioned earlier, all of these have a couple of things in common. One is all markets recovered.
Right.
So that's the
across
good
these
news.
recessions.
But we always have stress during this environment. And to that extent, when someone is under stress, don't tell me, as you mentioned earlier, to do nothing. My goodness, I got to fight, I got a flight, we got to do something. And so what I like to assure people, and what I did during 2008 and other times, is look, you are doing something. You have hired these money managers, you've hired us, we're working at it. And so hopefully you have been structured prior to getting into these environments, because we're going to have more recessions.
Right, they're coming.
Are you structured properly to manage your risks where you're comfortable during this environment? If your feelings change, we need to know about that. We can do something about it.
Right.
But I don't like to tell people do nothing. You have done something already. You're paying managers, you're paying us, and that's really what we're trying to accomplish in the whole process. So.
That's right. That's right. We definitely, do things, right? We are active managers here, and, we kind of take risk off or risk on depending on the situation. So Chuck's right. You need to understand when you have an advisor, especially if you're working with us, we are doing something, and we always do want to talk to you. And that kind of comes, kind of brings this talk kind of full circle. Here we are, we're still in the middle of this pandemic. We don't really know what's going to happen. It could go either way. And, so it's important for you to understand what risk you're taking and have that discussion with somebody, because, you want to be ready, and you can be ready. You can make changes now to even be ready if you don't feel like you are. So that's, that's kind of our, how we want to end this webinar is just, what we've talked about. We talked about past recessions, just some history, what's happening now, and the risks that are out there and things that you need to think about. And so again, if you're concerned about that or you want to talk to somebody about that, then you can always give our office a call or email Amy, and we can get back with you on, some of the things that we do here, right? To help
recessions, bear markets, they're going to come and go. Again, the market's recovered, the economy recovered in all cases. All investments have risk. Some are more transparent than others.
Right.
But all investments have risk, and so you're right. It's important that using science and the art and the relationships that we have with the folks that we work with, that they know that they're prepared when it's something like this.
That's right. And we're so comfortable with our clients, so we know who we need to talk to kind of get ahead of it, when something happens that's unexpected, like this was, especially. I mean, this came out of nowhere.
It's still stressful, still not easy,
Mhm.
but hopefully you're properly prepared and you're not going to suffer.
Yeah. Okay, so we're going to go ahead and open it up for some questions. And I actually have a couple that we got before this started. Okay, so, and just remember, we are going to do a drawing for you guys. So if you want to ask some questions real quick before we're done, we'll try to get those in. And we're going to do a $50 gift card to the restaurant of your choice. So one question, Chuck, that we have is, I read a lot of things out there and I wonder how much I can believe. Where do we get good information? How do we know what the information we're reading is good or bad?
Oh, that's a good question. Might not be a good one to ask. I get upset about this all the time. I have to, I go back, even when we first had the individual retirement accounts, there was a magazine called Money Magazine. I don't know if anybody out there used to get Money Magazine. People thought it was kind of like the Bible for money management, but Money Magazine came out. And so the individual retirement accounts were just now available.
Okay.
So they interviewed 3 financial advisors. So what are you advising your clients to put in these individual retirement accounts? Because they can't take them out till they're 59 and a half, otherwise there's penalty. So every one of them, all 3 of them in the article said they wanted to put them in limited partnerships.
Wow.
Now that doesn't mean that's necessarily bad things, but yes, many of them were bad things, but they put them in limited partnerships because they weren't liquid. Going to use it till 59 and a half, so it's fine.
Okay.
So you're reading this. Now you go to the back of the magazine and they ask the financial advisors, where do you put your individual retirement account? CDs.
Oh, no.
You go, whoa, how can I believe somebody that does that? And then there was a newspaper columnist came here from Boston. He was a food critic in Boston, and then he comes here now as a financial writer. And so he wrote a number of articles. So there was one that I knew was perfectly wrong. And so I wrote him a letter. I said, okay, you're wrong, and here's the reasons why. Now my response was from his assistant.
Okay.
You got to understand that our columnist has to write an article every week, and he really doesn't have time to research all of this. And so it's just really. I'll also share with you, we had a friend who wrote a book, and it was back to my Y2K, year 2000.
Okay.
So he says, Chuck, I'm writing this book about what? Well, Y2K, it's going to be bad. So people need to sell their house, need to rent, put all your money in treasuries. He had a list of things you're supposed to do. He's writing this book. I said, John, you don't know that. He says, I know, but if I'm right, I'll be famous. If I'm wrong, everybody will forget about it.
Oh, gosh.
Now, he was wrong, but he was right, because today he's still a speaker. He's on TV periodically. It's like, and even today with some of the headlines, like I was even reading this morning, you have people popping off about where this is going and what's going to happen. And they're being very definitive that this is, and they don't know that.
Right.
And so it's the same thing. They're trying to be famous. If they're not, then they're wrong. And so the answer to your question is, that is a difficult thing. The important thing is that people do know who they're reading, why the article might be written, who they're reading, what they're writing about. I will share with you that there's at least 4 of us in this office who could probably be in a webinar 8 hours a day, every day. And so we spend a lot of time listening, doing research, trying to figure out the consensus and what things are true, what isn't. And so relying on a financial advisor, I'm sorry, it's a little self-serving, but we do spend a lot of time trying to help define what is reasonable, accurate, and a consensus. But that is a valid concern. There's no one person that knows everything. I know even in our office, Brian on occasion goes to Goldman Sachs, and we sit inside with them. He sits with them and picks their brains. He's been to BlackRock. And so that's something that we do and try to help with that. So that's the best answer I can give you.
You got to be careful. You got to do your research. You got to really know where it's coming from. And that's what we do here, and we can help with that for sure. Okay, let me see. I think we have time for one more question at least. Okay, so are you telling me I am unable to avoid risk?
Well, you're not going to like this answer. No, you cannot avoid risk. The point is, you need to be cognizant that there are risks in everything that you invest in. Now, as I said earlier, some are transparent. So it's very comfortable to have your money in a CD because you got no loss of principal.
Right. But interest rates could go up.
And it's hidden because you don't realize purchasing power and inflation,
Yeah.
my money isn't worth as much as it was.
Yeah.
So the
Two
answer
risks with
is,
that, interest rates or inflation, right?
so you have, I think the point of it is that just we really want people to be aware that everything has risks. And so what we need to help determine is which ones are important and can we somehow through diversification minimize those risks so that it smooths out your path as opposed to being a really bumpy, rocky
And
ride.
just understand what risks you're really taking
Yes.
and where you're taking it so
Right.
that then you'll understand when things happen, how it affects you, right?
That's it.
Yeah.
That's it.
All right, so I think that's all the time we have for our questions. Our next webinar is going to be in 2 weeks. And we are probably going, now this topic's kind of, we're working on it, but we're probably going to go into a deeper dive on some of the sectors that have been impacted by COVID-19. And when I say sectors, I mean, we may talk about the travel, our airline sector, automobiles, hospitality, retail. There's a lot to choose from here. So we may go into some things that we're seeing in each of those sectors and what we think is happening there. So I think that will be really interesting if you want to mark your calendar to attend that, because it'll be Thursday 2 weeks from now. And then we are going to go ahead and again we're going to announce our gift card for this week, next week. But right now I'm about to tell you who got the gift card for attending our webinar last week and submitting a question. And their name is Deepa D. And Amy is going to be reaching out to them to let them know that they are going to be getting a gift card and work with them on where they'd like that gift card to be too. So anyway, we really appreciate you attending our webinar. I hope this information was helpful. And we are looking forward to doing another one in 2 weeks. Thank you so much. Bye-bye.
Goodbye.